Kia ora whānau, and welcome to another episode of Get a Job and Get Healthy by Costas Enterprises. I am your host, Alex Costas, as always. As you can tell, I am driving again, which I know I shouldn't be, but I am. Well, what are you going to do? So, today's episode was actually suggested to me by one of my good friends, who basically just wanted to know, I told him that I started investing in stocks and shares and ETFs and all that sort of stuff, and he just wanted me to go over a few things, like what I basically invest in, what's good, what's bad, and all that sort of stuff. So I'm going to be flipping between the podcast program and my actual Sharesies account, and give you also just a little bit of a brief background about why I do these things. Now, as always, if you want to find out any details about me, you can find me on at the Kiwi Don for Instagram and Twitter. You can email me, doncostas@gmail.com. That's DONCOSTAS@gmail.com. That is N for Nike. You can also find me at costasenterprises.business.blog, which is my actual website. So, yeah, I thought I'd talk to you a bit about my Sharesies account. And for those that don't know, Sharesies is a sort of a stock portfolio slash managed funds slash ETFs that runs on the New Zealand Stock Exchange. You can use the app and the program to buy shares. You do not have to, pay a brokerage fee. You do just pay the fees for what it is, the shares that you're actually paying for. And it's a way to encourage New Zealanders to basically start investing. Great little program. It's been really, really popular with me for the last year, and I can't recommend it enough. The reason I can't recommend it enough is because, unlike other times when you invest, if you were investing normally, you would have to buy a certain amount of shares. Like, you can't just put $1 on or $2 on and that sort of thing. Like, you would have to actually buy a whole chunk of a share, so you might need a spare $2,000 around. Sharesies is a way of you not needing that $2,000, and you can basically just put whatever you've got available to you that you want to invest, and you can share how you want to do that. So it's a very, very simple system. Now, it does get updated every couple of minutes while the New Zealand Stock Exchange is open. The other thing you can do now is you can actually buy on the US and Australian stock exchange as well. So the US one is both, the NYC and all those fun ones. You can do all of them, which is really, really quite cool. And while you do have, you are limited to quite a few investments, you don't get every single investment on the New Zealand Stock Exchange, and on the New York Stock Exchange, but you get a fair amount. And definitely the big ones are there, like, your Apple, your Walmart, all those sorts of ones are always there. But what I started doing was, when I first started my Sharesies account, I literally started with, $15, which was what I started off. And I started adding to it. Now, the important thing when you are doing with shares and managed funds and ETFs, whatever you decide to invest in, and I'm not going to be telling anybody, I'm putting a big, big disclaimer. I'm not saying to everybody, you should be investing in these particular things. It's just, these are what have worked for me. I more want to focus on the types of investments that I'm investing in through Sharesies. So you will notice that most of my shares aren't actually specifically shares themselves, like business shares. They're actually ETFs, or electronic traded funds, or managed funds, or even index funds, which is what I've started getting into now. So let's break down what they are. So shares, when you invest in a share, basically what you are doing is you are investing in a company. So you can own certain parts of a share, or a whole share, or more than one share. For example, I have ever since I was a little boy, I used to collect Coca-Cola, and so it was always my dream to own a Coca-Cola share. Now, growing up, at the time when I was growing up, these were like crazy, like $135 a share. Now they're about $54 a share US. So obviously they have gone down, but at the same time they are still, $54 is still about $100 New Zealand here anyway. So it's still pretty good. So I own that one share. I only have one share. I don't intend on putting more in Coca-Cola at this stage. It was just, it's one of those pipe dreams that I've always had and always wanted, and really, really happy to have. So what I did start doing is I started investing in different little stocks, and I put like a couple of dollars here and a couple of $30. I'm going to be level with you guys now. I've got about 1,500 in shares total, and ETFs and funds and managed funds and index funds and all that sort of stuff. When I refer to shares from now, I will make it very clear that when I'm talking about company shares, that it's company shares, not normal shares, but otherwise you can take shares to be investments, basically. So you're investing in a particular company, and these are companies that are trading publicly, and give you a chance to actually, purchase a part of their share, which is quite cool. The next thing you've got, which I personally invest in, are ETFs, which are electronic traded funds. Now, you guys have heard me talk about reading some books like Money Mastering the Game, Rich Dad Poor Dad, all those sorts of books. All of those came from things like learning about these ETFs. So one of the things, the key rules that everyone always talks about is diversifying your portfolio. Now that means not putting all of your eggs in one basket. Not putting, if you've got, $10,000, you don't put all that 10,000 in shares. Or if you do, you don't put it all in one share. You spread your investment around. One of the ways you can do this is by putting it in an ETF, which is a collection of, the F part stands for funds. So because it stands for funds, it means that you can actually have multiple companies all within a fund that is not managed by you, it's managed by someone else. So it's kind of like a managing fund, but except these ones are a little bit cheaper to get into, because you don't usually have to pay certain costs. And there are New Zealand ETFs, there are American ETFs, Australian ETFs, they're all over, and they can be different things. So one can be for certain industries, like for example, I personally have an ETF which is based on the US S&P 500, which is a Vanguard index fund as well, ETF fund as well. Now, funny, I actually own money in both the Vanguard and the ETF, the New Zealand equivalent, and I will continue to hold that because that's one of my best investments that comes back. That said, there are a lot of different ETFs. One can be based on technology, one can be based on, real estate, one can be on just gold and silver mining. All of these sorts of things, they will take companies from all across and use those. Now, the reason I gave the example of the S&P 500 is for the simple reason that in America, the Vanguard S&P 500 is effectively, it is based on the top 500 grossing stocks. So the top 500 that are making the most money all go into this fund. And then as soon as one is gone, like say for example, if someone doesn't meet the actual list of the S&P 500, then that person's out and another business comes in, meaning that usually it does pretty steadily. So for example, in the 2008 economic recession that we had, the only sort of managed fund or ETF fund that was still trading in a positive, like granted it did take a dip, but it was still above 3% of what it was normally, did mean that it was actually trading in the positives, and it was the only one to do that. Now, one thing I do want to preface very, very carefully is shares are very much high risk. That is why I say, if you are investing in a company, just a sole company by itself, be very careful, because they do move quite a bit. Now, there are people like Warren Buffett, who of course made billions doing this sort of thing, where he'd buy a company and he'd hold on to it no matter what. But he would research the company like nobody's business. So always do your research first. Don't just put money in for any old one. Like, look at the 5-year return. If there haven't been 5 years, look at the last year return. Don't just buy any old share just because you like the sound of it. Like, actually do your research. It's still money that you're putting away. Now, an ETF, a managed fund, and an index fund, they're a little bit risk adverse. Okay, so they're not going to be as risky as shares. They won't go up and down as much. They still do go up and down, I'm not going to lie, but because you're dealing in a whole lot of funds, like with an ETF, you might be dealing with S&P 500, you're dealing with 500 top value American companies. So, it might go down for a little bit, but it usually goes back up, and it usually does in the positive. Since I bought it, I've only gone, I haven't gone on the negative once, but I have gone to almost what I bought it at, which was, it was still trading quite high at that time. So the main thing to remember is, if you are looking at investing in the stock market, as people say, before you start going in stocks and shares, do actually think about putting some of your money in an ETF or a managed fund. Now, a managed fund is similar to an ETF, except that it is actually managed by someone else, like Vanguard, Fidelity, and they actually they keep their eye on it. Again, they try to make sure that there's no underpricing, overpricing, all those sorts of things. And they manage the portfolio for you, so you don't have to pick the shares that you want. Now, if you enjoy picking your own shares yourself, you can do that, but you won't be sort of protected by a fund manager like you would be with a managed fund or an ETF. But yeah, managed funds are basically like, you might buy a technology managed fund. We'll use technology again for the example, and it might have it might have Lenovo, it might have Apple, it might have Windows, Microsoft, and they might have certain parts of that stock that is part of this managed fund. Again, funds can go up and down like all other investments. So you're investing, like there's always going to be a risk. But because it's a managed fund, it is usually managed pretty closely. It's not sort of, they don't sort of pick it and leave it. They pick it, and if it needs to change, they take it out, replace it, or they add to it. And so again, it's another way of diversifying your portfolio by buying one particular type of share. So if you are new, like say for example you've got $500, you want to put it in Sharesies, you want to put $500 in the stock market, rather than putting it in one company to start off with, I would put it in either an index fund, a managed fund, or an ETF that you have researched. I would not put 500 straight into a share first, because if that share goes down, you're going to feel really, really deflated. Whereas at least with an index fund or a managed fund or an ETF, because those are, being managed by other people, it's not going to, they don't usually want to lose money for you because they're getting paid to make that money, and make sure that portfolio is actually delivering a positive as opposed to a negative. So managed funds are similar to ETFs. And then you've got index funds, which I've literally only just started learning about. But an index fund it's a little bit different. So, you can get total stock market index funds. Now, what an index fund is, it is basically a way of covering every stock that is in that particular field. Again, we'll use the technology field, on the stock exchange that you're doing it for. So, for example, I have the Vanguard index fund, and so all of Vanguard's properties, this takes a part of all of those Vanguard funds, all those ETFs, and it has a little piece of each and every single one of them. Now, I won't lie, the current Vanguard index fund that I am using is trading at about $419 a share US. So that is quite a bit. Now, I do not have a share yet, let alone $100 worth of this US just yet, but I'm going to start adding to it. So I just recently added $100. That got me about $80 US in that particular share. And that was about $200 New Zealand. So I'm not going to lie, it's not cheap. You will find it can be a bit expensive to invest in foreign shares, but I am trying it because I'll be honest, I've made more money out of my foreign shares than I have my New Zealand shares, because New Zealand Stock Exchange doesn't really, it works, but unless you got in early with places like Westpac or Fisher and Paykel, then you're paying up the wazoo basically. So on the flip side of that, I've started investing in index funds because it doesn't matter how much I'm going to get. At the end of the day, that is going to compound. And index funds, managed funds, ETFs, they are more likely to have an 8% return every year. Now, just think about that. An 8% return, I know it doesn't sound like much, but given that from the bank and your savings, you're literally getting 0.25% or a 1 to 2% maximum for a long-term fund. So why would you not take some of that money that you would put normally into the bank, take half of it and put it into an index fund or an ETF? Yes, you will be buying it high. Now, a lot of people go, well, I'll be buying it so high. What if it goes down? Well, what if it does? What if it doesn't? The main thing I want to stress, the difference between shares, index funds, ETFs, managed funds. With index funds, managed funds, and ETFs, they are the kind of investments you want to hold. Okay, these are the ones that you want to put in for about 10 years or 20 years and then let them go once you're ready to retire, for example. Now, the reason I say that is because an 8% return on your money every year, well, each time it's going to compound. So if you haven't heard before, compound interest is a really huge thing, and it took me a long time to learn this, but once I learned it, I was like, I'm going to start doing that. And basically the way that the compound interest works in the index fund, for example, or the ETF or the managed fund, is you put your money in, you get 8% of what you put in roughly back. Now, you may or may not get that. So if something does happen, of course, I'm not guaranteeing 8%. You may only get 7%. But at the moment, I have a 19% return on my index funds, which is pretty good because I bought them low and they've just gone up. Now, I'm not lying to myself. I have had days when I've been below. I was minus $30 earlier this year, and now I'm up like $230. So I'm not going to make it sound like, you are guaranteed an 8% return. You are not. You are definitely not. But over time, the 8% return is more likely from an index fund or a managed fund or an ETF than your shares, which you might have a share which just skyrockets, and then the very next day it plummets. So it's one of those ones where you got to know when to sell it. So, for example, I could have a share in Coca-Cola, like I said, and say Coke develops something. They develop a new type of bottle which is 100% biodegradable or whatever they decide to do. Or they really release a new version of Coke with alcohol, like Mountain Dew with Pepsi, with Mountain Dew with alcohol, for example, and their stock price just plummets because people don't want Mountain Dew and alcohol. What the fuck? Then I would have lost all that money. And there's, unless you hold that, you got to wait and wait and wait before you can actually get it back. Now, with an ETF, you're more likely to, you may take a loss in part of it, but you won't lose all of your money, because at least some of your companies that are in that managed fund or that index fund or that ETF will actually be doing reasonably okay. You might dip, but you won't necessarily lose everything. And overall, they are just a safer investment. Now, of course, they're not as safe as cash and they're not as safe as bonds. If you can get into the bond market, you will get a very low return, but your money is more likely to be safer. You're more likely to get a 3% to 4% return. Now, some of the books that I've read, one of the things that they also talk about as well is buying low when other people don't. So if there is an economic crash tomorrow and you've got the money, buy those companies. I know everyone's like, oh my God, no, you don't buy when it's low. You don't buy, if it crashes, you don't buy, you sell, you get rid of everything. Well, that time when you're selling, everyone else is, all the smart investors are buying that stock low, so that when it does eventually go back up, which it will. And the same can be said about the shares. Most shares, if you buy low, they will go up eventually in time, but you've got to hold them. Now, that is the difference. Like Warren Buffett, as I said, his advice is sort of like, if you're investing, hold the investment. Don't sell it unless you absolutely need to. And the first thing, when the price starts going down, people go, I got to sell it. I got to get rid of it. I've done that myself. You got to train yourself to go, you know what? No, I know the share market and the stock market is going to dip. It is going to dip at times. If it dips for like 2 weeks, then think about selling. You might have taken a loss, but at the very least, if you can hold on. Because eventually it will come back. Okay? However, this is all depending on your research. Now, I'm not going to guarantee that every stock comes back. It doesn't. There are some stocks that just completely flat out. This is a reason why I don't invest in Bitcoin or Ethereum or any of the cryptocurrencies yet. It's still unproven. So there's a story out there where, everyone's like, oh, well, I made this much money on Bitcoin. Mr. Beast made, $6 million off Bitcoin. And now he makes his money off YouTube. Yeah, he was lucky to buy Bitcoin when he did. And sell it when he did. He was very, very smart. But now, if you tried to buy a Bitcoin now, it's going to cost you, $132,000 New Zealand? Maybe US? I'm not even sure. For one Bitcoin. That's crazy. However, that money can swap in a dime. Literally in 3 minutes, Bitcoin went from one of the highest it was trading to $3 a Bitcoin. It dropped way too quickly. And people couldn't get their money out fast enough. That was the problem. They lost millions. So please, 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 if you're going to invest in Bitcoin, be careful. If you're going to do not invest in Dogecoin or any of those weird meme cryptocurrencies just because people are talking about them. Be very, very careful with your investments. I've talked about investing in NFTs. You can invest in NFTs as well. They are proven. Like they're still selling at the moment quite significantly. But when it comes to cryptocurrencies, at the moment, you've got to be very, very careful. It's too volatile and there's no way to get your money out. How many places do you know that actually let you pay for Bitcoin? Until it becomes an actual currency that you can use, you have to be mindful of that. Now, that said, there are Bitcoin tradings on the stock market. Should you buy in that? Do the research. Have a look at it. Is it going up and down quite a bit? How much is a share? What's the 5-year, turnaround for it? All those sorts of things are the sorts of things you need to be looking at first. So when I look at a stock or a share or a fund, what I do is I immediately have a look at it. I read what it is that says. A lot of people just buy it because the name sounds good, or they look at the highest price change. The price change is one thing that you can look at, but you need to actually do your research. You need to read. So once you've had a look at that, look at the last 5 years. Look at the last 1 year. Is it going up and down? Is it volatile? What was the lowest it was? What was the highest it was? Are you buying it too high? Are you buying it too low? If you are buying it way too high, it's okay. Do you actually need that stock right now? You can wait a little bit, see how it goes. However, if it's got a 5-year trend where it's just gone up, and it just keeps going up, buy it now. Okay, the reason I say that is the sooner you get in and you buy it, the more you'll have it when it grows. Like that's what I'm finding with this Vanguard index funds and also the S&P fund. The S&P, when I bought it, was $250 a share. It's now trading at about $409 a share US. $335 it was when I first bought it, and it's already dropped to $409, and that's in a year. So just think about that, and because I've got that, that's one of my highest returns. So from that investment alone, I've already made like $50 US, which is about $100 New Zealand. So do just take that time, have a look around. If you see something like an ETF or a fund that is going up, and it has been consistently going up for 5 years, put $100 on it, see how you go. Buy enough to buy a share if you can. A lot of people buy Amazon, Microsoft, Tesla, all those sorts of ones. Look, they're proven things. Tesla goes up and down, but Tesla halfway through the year split their stock. So people that had $400 stocks now had a $200 stock, and they were like flipping out. Because people put big money in that. So just take your time, realize what it is that you're doing, and try play the market. Now, my type of investing is probably different from yours. If you are one of these ones that wants to put it in, take it out, put it in, take it out, Sharesies is a good plan for you. You will get charged on every fee transaction, but you won't get charged a brokerage fee. You won't get charged very much. My type of investing is I'm going to buy a whole lot of low risk, high or semi-high return. And by that I mean the 8% returns. The funds, the index funds. So because I'm doing the index fund, that covers the whole stock exchange indexed. So whatever's up, whatever's down, regardless, if that stock itself, if the whole exchange itself for that particular field is going up, that is what I get paid on. Now, another thing you want to look at as well is whether or not the stock that you're going to invest in actually will pay dividends. Now, if it pays dividends, that's cool. You might get a couple of dollars, a couple of cents. You might get $100, $200, depending on how much you've invested. And that is all based on a 3-monthly or a 6-monthly or a yearly return. And that's extra money for you, which you can choose to reinvest. I strongly suggest, in your first instance, reinvest. Now, if you've got a lot of money invested and you get enough dividends, say, for shits and giggles, let's say you've put $1 million in the S&P 500 and then you get paid $30,000 in dividends. Can you live on that $30,000? Take it out. Keep that million in there. When that goes up, it'll probably be 1.2 by next time, or 2.3. Then when the next dividends come in, live off those dividends for a year. That's the sort of thing you can start doing. That is what the goal that is the goal that I want to get to. But that's saying that means that I'm not just doing that. I'm trying to get across everything. But I did want to talk to you guys about the ETFs, the stocks, the shares, the funds, all that stuff. Start young. If you've got a child, Sharesies do a child's account. Create a child's account for them. Put $20 a fortnight, or every time you get paid, put $20 in their account. Start teaching them how to use their shares, how to make their money. Then by the time they're 18, you never know, they could actually have enough money for a deposit for a house. Just let that sink in. If you have a 5-year-old, a 2-year-old, put $20 in a fortnight, because that money will compound. Let them learn how to invest it. If you're investing for them, you can invest in the exact sort of thing I'm talking about, the index fund. That index fund will then yield you 8% based on what it is that you put it in. You can set up automatic funding allocation through Sharesies as well. So they will automatically invest for you based on what you want. That's another way of you taking the whole Mickey Mouse out, taking the man out. You can literally just set it up so it automatically does it for you. Now, me personally, I want to learn this stuff. So what do I suggest? Let me read through what I suggest. And again, this is not me saying you should do this as well. This is me saying this is what works for me. So, first off, I've got one of the shares that I'm going to be putting in a bit more is the Fidelity MSCI Information FTEC, which is on the New York Stock Exchange. That's Fidelity, FIDELITY. Now, the reason I'm going to start doing in Fidelity, once I've earned a couple of shares on my other ones that I want to do, is I've put $1 in that account, literally $1, and I've already got a 9.83% return on it. I'm sitting at $1.10 already. And when I start building that up, it's going to get better and better and better. Now, if you're going to invest in New Zealand, you've got the Smart Shares US 500 fund. Okay? That is based on the Vanguard S&P 500 ETF. Both of those are good. Both of them do have a strong yield. Also on the Smart Shares US fund, which I want to talk about, is this is also trading on the New Zealand Stock Exchange, is the Smart Shares US Large Growth Fund. Now that is doing amazing for me. I've got a 29% return on that. And the last one I want to talk about is the new one that I've started doing, which is the Vanguard Information Technology Index Fund. Okay, now that is the one that I said I discovered. Now, for example, 5 years ago, this was trading at $115.82. That's 5 years ago. It's now trading at around $408.10. So if we go back and you go, oh, well, Alex, that's crazy. A year ago, it was trading at $295.97. So, believe me, this sort of thing is worth getting looked at. So let me know, hit me up, doncostas@gmail.com. Let me know what you decide to go for. What shares should I invest in that you use? Have a think about that sort of thing, because I think it's really, really important that we actually educate people. We tell people this is what you can do. If we can help people just invest $10 a day, that's $70 a week. Imagine if that's $70 in a year's time. Hang on, I'm going to do a quick calculation. That $70 a week becomes $3,640 in 52 weeks. Now that $3,640, depending on what it is that you put it on, hang on. So if you took the 8%, and this is on a basis of 8%, that 3,000 and where did it go? God. Basically, you would get about $292. Yeah, so the $3,931.52. That is on the basis of $70 a week. Now, that is, of course, assuming that it's got an 8% return, and this is if you did it in the S&P 500, for example, and there's no downfalls, but just on a basic 8%, you're gaining almost $300 on your initial investment. Something to think about. As for now, guys, as always, I want to say thank you. I love you, as always. And good luck. I truly mean that. I hope you all have a good day. One thing I haven't talked about is, of course, we are in lockdown at the moment, level 4. We might be in lockdown a little bit longer, so I might even try to get a couple of blog posts up over the next couple of days, hopefully, because I think this sort of thing is important. But yeah, I will try to let you know what's going on. All right, guys, I love you, and good luck.